Oil's bullish momentum has started to wane over the last fortnight, this after crude posted 2 consecutive months of gains, partly thanks to supply cuts between OPEC and Russia. Analysts at Barclays, however, argue traders are now overly bearish, retaining their price target on Brent for $70 a barrel by year-end. Gaurav Sharma is an independent oil analyst and contributor at Forbes and is here with me now to discuss. Gaurav, good to see you again.
Good to be back.
So we just had this inventories data which saw a massive increase in US crude stockpiles, partly thanks to record shale flows. Do you think we're at the end of this bullish trend for the market?
I certainly seem to think so, but then the oil price has been oscillating in this range for a while. So you might say we might have been at the end of the bullish range, but I think even if we turn negative, we're not going to see $40 or $30 levels. We'll turn mildly negative, and then we'll keep having this oscillation between positivity and negativity. And basically, if you look at it, the bull run took it all the way up to 65. The bear run, which followed after oil had actually, unmerited in my opinion, spiked all the way up to $80, took it all the way down. And now off late in the first quarter, and we're nearly coming to the end of Q1, the way I see it is that the oscillation is only $3 or $4 either side of 65. So for me, the key support level I'd say would be $64.50, and I think there or thereabouts. And if we see that being breached, then we could go all the way to 60, 62. Somewhere in that range. But if it holds, we could go all the way up to 67 and maybe even 70. But we'll keep having this ping pong because there are too many variables right now.
Too many variables, one of those being the outlook for demand. So I wanted to get your view on where you stand on the global economy, because it's clear that we're starting to see some kind of slowdown, particularly in Europe as well as China. China recently cut its growth forecasts, but to counter that, it also cut taxes. So, I mean, there's a lot of things going on with the global economy. Are you bullish on the outlook?
Well, I would say I'm short term. I'd say we'd be at the levels we are, but I think in terms of the oil price, I think my long-term outlook is the same for Brent, 65 to 70, and for West Texas, 60 to 65. Perhaps even the lower end of that level for the West Texas. And the reason for that being, well, I think people are slightly overplaying the China slowdown. It's a correction because the dynamic of the economy is changing into a more service sector driven economy. But we're still looking at somewhere about 6 to 7% growth rates, and they're particularly healthy. They're not particularly healthy for the market because we're not seeing double-digit growths, but still China will keep going. Now, in terms of the more holistic demand, I think the key demand center for a lot of oil exporters is India. Even shale oil is heading to India in copious amounts, like crude is. So if you take India as a positive, and you take Japan as a negative, and South Korea as a negative, and the United States not turning to the global markets as much as it should, and perhaps China being sort of in the modest middle, I'd say demand was still, total global demand would still say sort of just about south of 100 million barrels per day. And demand growth, it'd still be about 1.1, 1.2. I think the most optimistic figure that I have is 1.4, but I don't think that's going to be matched in terms of demand growth. Now, what does that tell us? If we have this sort of 100 million barrels per day global demand there or thereabouts, then we are looking at a price range where we are at. I see nothing on the horizon that is sort of pulling the price really high, or there is an overtly bearish factor. So we're not seeing 100, we're not seeing 20, and Wall Street has flirted with those hypotheses and it's been proved wrong. So what we have here is a level for Brent of 65, either side of which you can have a 300-point spread, and C, play the news. I mean, if you are a spread bettor, you play the news. And I think between now and the run-up to the next OPEC meeting, which is the 17th of April, we could see a bit of to and fro, kind of positive, kind of negative, but not moving really convincingly in either direction.
So what are you expecting from that OPEC meeting then in April?
Oh, it's going to be a tough one. I think the Russians were quite miffed last time around. They thought the time has come to open the taps. But I think at least publicly, at least on paper, the Russians would come into town, perhaps agree with OPEC that they should continue their deal at least till the end of the year, at least on paper. Now, where is that level of compliance going to be? The aggregator said last year it was a very healthy 120% level of compliance. Now, if that sort of comes down to sort of 80 or 100, and OPEC is back to its 32, 33 million barrels per day levels, which is around about where it is, then the market would kind of look at it and say, well, they're not exactly taking an awful lot of oil out. And lo and behold, as has been the case for the last 20, 30, 40 years, it always hinges on what Saudi Arabia does or does not. Right now, the data aggregators, the Platts and Argus of the world, are saying that Saudi exports are being curbed. Now, will Saudi Arabia suddenly sort of realize in summer, well, nobody's really playing ball, and why are we carrying the can? And they suddenly open the taps. Then it could be a very different scenario. So tough times, but I think on paper they'll probably agree to roll on their cuts deal to the end of the year.
How much do you think OPEC will be listening to Mr. Trump? He tweeted last month saying that the oil price is getting too high and OPEC, please relax. That coincidentally, or not coincidentally, depending on how you look at it, actually coincided pretty much with the peak in oil after that strong rally that we saw for 2 months. So how much sway do you think Mr. Trump has in the markets, and to what extent can he influence OPEC?
I'd say not much as he'd like to have,
yeah.
but I think it's among those confusing variables. Here we have an occupant of the White House doing diplomacy by Twitter. You know, so this is unprecedented. So each time he says, it factors into the sentiment. It may not last, but for that intraday session, it would cause a dip of $2 or so. Now we might have additional American oil coming onto the market in May because he started talking about the strategic petroleum reserves. Whether the markets need that or not, Trump still has that Trump card. So if you're doing diplomacy by Twitter and you suddenly send out a tweet of this nature, the market will respond. It may not last. And that's what makes life so confusing. He doesn't have the kind of influence he thinks he has, but then the Saudis and the US have been really close allies for decades. And if Mr. Trump says something, the Saudi government generally listens. And I think if they may respond one way or another, they may directly say that they're not responding to it and they will not cut or they will not raise. But deep down, at the end of the road, they go on complying. And let's not forget, you know, we keep talking about the US turning less to global markets, but Saudi exports, especially heavy crude, which is a very different variety from the American crude, which is much lighter and sweeter, those exports are continuing at pace. Their market share of the US heavy sour market still remains about 18 to 20%, and that's been the case all along.
What about if we get a trade deal? Is that likely to give a major tailwind to the oil price, or do you think that that's not really necessarily something that will weigh heavily on the market?
I think this will be very interesting. I think the talks will continue, but you will probably have an announcement one way or another by the third or the fourth quarter of this year. And yes, that could provide a tailwind. I think that's a very key thing. You see, nobody wants a trade war. So at the end of the day, when the Chinese economy is slowing down and there is sort of the overhang of a trade war, that is bad news. So the talks will continue. It'll keep sort of lurking around, keep impacting trading sentiment. But I suspect that these talks will continue well into the year. And by Q4, if we have some sort of tailwind, then I think that could be something that would convincingly push Brent towards $70. And I think that's what a lot of traders are thinking in terms of the front month contract. What's
sort of your year-end target for WTI and Brent?
I think what we see now is first point is, of course, the OPEC meeting on the 17th of April. Their JMMC, the OPEC and the non-OPEC guys will meet later this month, but of course the key is the April 17th meeting. And I think they will probably call another meeting, because this is an extraordinary meeting. They'll call a normal ministers meeting or the conventional summit, as it were, in the summer. And that will give us some indications. Now, if at that summit the Saudis and the Russians turn up and they say, I think we've done our job, we've sort of balanced the market, which is the expression they almost always use, then there could be an uptick. But I genuinely do not think there is going to be a zip in prices, an extreme spike. If there is an extreme spike, it would be thoroughly unmerited because the volumes don't dictate that. I think my India price remains what it was. I think just shy of 70 or just about 70 or so, quite like last year. And I think the key takeaway is we've had a lot of kerfuffle. We've seen the oil price go up to 80. We've seen a very bearish November and December. But for all of that, if you draw an average curve, the last 12 months, we've just really haven't moved. If you look at the average price 12 months ago to where we are now 12 months ago, there really isn't much movement. The movement is in the weekly play.
So what about in stocks? We've had some pretty good earnings in the UK out of Shell and BP. Where are the investment opportunities right now?
I think based on my oil market analyst hat and the kind of exposure that I have, I would say, well, let's start with the blue chips first. If you look at BP and Shell, I would say I'm buy on BP, and I have a 650p price target, not just precisely because the oil price is in a very stable climate, because I think Bob Dudley is doing a lot to sort of change their ways and to sort of sit at the forefront of changing mobility, like for instance having electric charging points at their gas stations in Mexico, and a lot of downstream work. And they're also doing a lot towards automation and in terms of expanding the portfolio. So I'm quite bullish on BP. So I'm buy on BP with a 650 price target, just shy of 540 before we came live. As far as Shell, I would say hold. I think it's a RDSB is a very expensive stock. You have to think heavily even if you want to buy 100 shares. And I'd say hold your levels, because a dividend-paying stock has never failed. Both these companies are going to pay dividends this month itself in March. Mid-caps, Petrofac, very interesting. They had the SFO charging of an ex-employee. It's put a cloud on their heads, and the oil price, I beg your pardon, the stock price plummeted to 395p at one point. And I think people who are entering into Petrofac right now could, hypothetically, earn some good returns there, because we don't know where this SFO investigation goes, and it's worth pointing out that the SFO has not exactly charged any Petrofac employees now. So it's cheap right now. It's worth buying. It's good mid-cap stock.
Gaurav, thank you so much for your time.
Thanks.
That was Gaurav Sharma, independent oil analyst and Forbes contributor. I'm Victoria Scholar, and thank you for watching IGTV. We'll see you soon.